I've watched people repeat the same mistakes for decades, and the root cause is always the same. They believe the world is driven by stories, by narratives, by the gut feelings of charismatic leaders. They are wrong. The world and the markets are driven by mathematics, by patterns, by cold, hard, unemotional data. After 50, you stop being surprised by the foolishness of crowds. You only become more convinced of the power of the numbers. I've seen brilliant minds fail because they overlooked one simple truth, a truth that took me a lifetime of work to fully appreciate. It is the most important lesson I have learned, and it has nothing to do with picking the right stock or timing the market. It has to do with seeing the world as it truly is, a complex system of patterns waiting to be decoded. The traditional approach to almost everything, especially investing, is a masterclass in self-sabotage. It is built on a foundation of emotion, intuition, and narrative. People fall in love with a company's story. They get swept up in the euphoria of a bull market or panic in the face of a downturn. They follow the herd, assuming that the crowd knows something they don't. This is not a strategy. It is a recipe for disaster. The market does not care about your feelings. It does not reward your loyalty to a particular stock. It is a relentless, unforgiving mechanism that operates on logic and probability. The greatest mistake is to believe you can outsmart it with your gut. The most important lesson I learned after 50 is this: you must remove yourself from the equation. Your emotions, your biases, your instincts, they are not assets. They are liabilities. The key to long-term success is to build a system that operates independently of your own flawed human nature. A system grounded in mathematics, driven by data, and executed with unwavering discipline. Today, I will explain the 5 fatal mistakes that stem from ignoring this lesson, and how to build a mindset that can withstand the psychological pressures of the market. There was a time when the value of a diamond was determined by a master jeweler's eye. He would hold a stone to the light, turn it over in his fingers, and, using decades of experience, declare its worth. His intuition was considered the gold standard. But then, a new technology emerged: laser scanning. It could map every flaw, every inclusion, with microscopic precision. It produced a report, a set of cold, hard data points. The master jewelers scoffed. They insisted their intuition, their feel for the stone, was superior. They were wrong. The data revealed flaws their eyes could never see. The market, slowly at first, and then all at once, began to trust the data more than the expert. The jewelers who adapted, who integrated the data into their process, survived. Those who clung to their intuition became relics. This is the same mistake investors make every day. They believe they have a feel for the market. They read the headlines, watch the news, and develop a narrative. This company is the next big thing. This sector is poised for a downturn. This is storytelling, not analysis. It is the equivalent of judging a diamond by its sparkle under a showroom light. It ignores the underlying structure, the microscopic flaws, the mathematical reality. The psychological mechanism at play here is confirmation bias. Once you form a narrative, your brain actively seeks out information that confirms it and ignores data that contradicts it. If you believe a stock is a winner, you will celebrate its good days and explain away its bad ones. You become a fan, not an analyst. The data, however, has no bias. It simply is. A quantitative model doesn't care about the CEO's charisma or the company's inspiring origin story. It cares about price-to-earnings ratios, trading volume, volatility, and 1,000 other variables that in aggregate reveal a pattern of probability. The lesson is not that human intuition is useless. It is that in a complex system like the market, it is a dangerously unreliable tool. You must build a system that forces you to confront the data, especially when it tells you something you don't want to hear. You must become the laser scanner, not the master jeweler. I saw this in another field, Medicine. For centuries, doctors diagnosed illnesses based on their experience and intuition. A patient would describe their symptoms, and the doctor would make a judgment call. Then came the era of data-driven medicine. Blood tests, MRI scans, genetic sequencing. Suddenly, the doctor's intuition was being tested against objective, quantifiable data. And often, the data revealed a different story. A diagnosis that seemed obvious based on symptoms was contradicted by the blood work. A treatment that had worked for 100 other patients was shown to be ineffective for a specific genetic marker. The best doctors did not abandon their experience. They integrated it with the data. They used their intuition to form hypotheses, but they used the data to test them. They understood that their judgment was a starting point, not an end point. The same must be true for investors. Your ideas, your theories, your narratives, they are all hypotheses. The data is the experiment, and you must be willing to accept the results, even if they prove your favorite hypothesis wrong. Let's explore this further. The master jeweler's story is not an isolated case. This pattern repeats itself across every field of human endeavor. Consider the world of professional sports. For decades, team scouts operated like the master jewelers. They traveled the country, watching young athletes play, and made decisions based on their gut. They looked for players who had the right look, the right attitude, the intangibles. They were searching for a story, a narrative of future greatness. Then, a small, underfunded baseball team called the Oakland Athletics decided to try something different. They couldn't afford the star players that the big market teams could. So, their general manager, Billy Beane, turned to the data. He hired a young economist from Harvard, and they started looking at unconventional statistics. They ignored the traditional metrics that the scouts favored, like batting average and runs batted in. Instead, they focused on numbers that had a stronger correlation with winning games, like on-base percentage and slugging percentage. They started drafting players that the other teams had overlooked, players who didn't fit the traditional mold, but whose numbers told a story of hidden value. The scouts and the old guard of baseball laughed at them. They called it moneyball. They said you couldn't build a winning team with a spreadsheet. They were wrong. The Oakland A's, with one of the lowest payrolls in the league, went on to have one of the best records in baseball. They had replaced the flawed intuition of the scouts with the cold, hard logic of the data. They had found the market's inefficiencies. They were the laser scanner in a world of master jewelers. This is the essence of the quantitative revolution. It is the recognition that in any complex system, whether it's a diamond, a baseball team, or the global financial markets, our intuition is a blunt instrument. It is prone to biases, it is swayed by narratives, and it is easily fooled by randomness. The data, on the other hand, is a scalpel. It allows us to cut through the noise and see the underlying structure of reality. It is not about abandoning human judgment. It is about augmenting it. It is about having the humility to admit that our brains are not wired to intuitively understand the complexities of a nonlinear, high-dimensional system like the market. It is about building a tool, a system, that can do what our brains cannot. That is the first and most fundamental step towards long-term success. Consider an ant colony. Each ant follows a simple set of rules, reacting to the chemical trails left by other ants. This decentralized system allows them to accomplish remarkable feats of collective intelligence, like finding the shortest path to a food source. However, it also makes them vulnerable to a phenomenon known as the ant mill. If a group of ants gets separated from the main foraging party and they lose the pheromone trail, they can start following each other, walking in an endless circling vortex until they die of exhaustion. From the perspective of any individual ant, its logic is sound. The ant in front of me is going somewhere, so I'll follow it. But the collective result is catastrophic. This is the herd mentality that governs financial markets. Most investors are not conducting independent research. They are following the pheromone trail of price momentum and media hype. When a stock is going up, they pile in, assuming the ants in front of them know the way. When it goes down, they rush for the exit, creating a stampede. They are all following a simple, seemingly logical rule, but the collective result is a cycle of bubbles and crashes. They are trapped in the antmill. Breaking free from the herd is one of the most difficult things an investor can do. The psychological pressure to conform is immense. This is driven by a deep-seated fear of missing out when the herd is charging towards a new high, and a fear of being left behind when it's stampeding for the exits. To be a contrarian is to be lonely. It is to stand still while everyone else is running. It is to buy when others are panicking and sell when they are euphoric. This is not natural. It requires a system. Our approach at Renaissance was to build a system that was, by its very nature, contrarian. Our models were designed to find signals that were non-obvious, patterns that were hidden in the noise. We didn't read the same news articles or listen to the same analysts as everyone else. We looked at the data, and only the data. We built a system that was deaf to the siren song of the herd. The lesson is this: the crowd is not wise. It is a force of nature, like a hurricane or a tide, and your job is not to predict its every move, but to build a ship that can withstand its power. You do that by anchoring yourself to the data, not to the whims of the crowd. Think of the dot-com bubble in the late 1990 seconds. The narrative was intoxicating, the internet was changing the world, and any company with a dot-com in its name was destined for greatness. Valuations soared to absurd levels. People were quitting their jobs to day trade stocks they knew nothing about. The herd was in a frenzy. But the data told a different story. Many of these companies had no revenue, no profits, and no viable business model. The numbers simply didn't add up. Those who followed the herd, who bought into the story, were decimated when the bubble burst. Those who anchored themselves to the data, who saw the disconnect between the narrative and the reality, were able to protect themselves and even profit from the irrationality. It is a painful lesson, but a necessary one. The applause of the crowd is a dangerous drug. The quiet confidence of the data is a much more reliable guide. The antmill is a powerful metaphor, but it's important to understand the deep psychological forces that keep us trapped in it. It's not just about fear of missing out or the desire to conform. It's about the very way our brains are wired to perceive social reality. For most of human history, being part of the herd was a survival mechanism. The person who wandered off from the tribe was the one who got eaten by the lion. So we have a deep primal instinct to stick with the crowd. In the modern world of investing, however, that instinct is a liability. Being a true contrarian is not just about buying when others are selling. It is a form of psychological warfare against yourself. There will be long periods of time when the herd is running in the right direction and you will be standing still, or even walking the other way. You will feel like a fool. Your friends and colleagues will be celebrating their gains, and you will have nothing to show for your discipline. You will be tempted to give in, to join the party, to stop fighting the tape. This is the moment of maximum danger. This is when your system is most important. A system doesn't get lonely. A system doesn't feel the fear of missing out. A system doesn't care if its friends are getting rich. A system simply executes its rules, day in and day out, with unwavering consistency. This is why the process of building the system is so critical. You must have such a deep conviction in the mathematical and statistical foundations of your models that you are willing to trust them even when your own instincts are screaming at you to do the opposite. I remember the financial crisis of 2008. The herd was in a state of absolute panic. The narrative was that the entire global financial system was on the verge of collapse, and it was. But our models were telling us something different. They were seeing patterns in the chaos, statistical signals that suggested certain assets were dramatically oversold. To act on those signals, to buy when the world was ending, was not easy. It required a deep faith in the years of research and backtesting that had gone into building our system. It required us to be deaf to the screams of the herd and listen only to the quiet whisper of the data. That is what it means to be a contrarian. It is not about being a rebel for the sake of being a rebel. It is about having a belief system that is so robust, so well tested, that you are willing to bet against the entire world, armed with nothing but your models and your data. There is an old parable about a group of blind men who encounter an elephant for the first time. One touches the leg and says, "An elephant is like a pillar." Another touches the tail and says, "An elephant is like a rope." A third touches the trunk and says, "An elephant is like a thick snake." They are all correct in their limited experience, but they are all wrong about the true nature of the elephant. They are each operating from a single, incomplete model of reality. This is a mistake that even many quantitative thinkers make. They find a model that works, a pattern that is profitable, and they fall in love with it. They believe they have found the one true way to understand the market. But the market is not a pillar, a rope, or a snake. It is an elephant. It is a complex, adaptive system that is constantly evolving. A model that works today may not work tomorrow. The patterns of the past may not hold in the future. At Renaissance, we never relied on a single model. We built thousands of them. Each model was like one of the blind men, with a limited and specialized view of the market. One model might look at short-term momentum, another might look at long-term mean reversion, a third might analyze the relationship between different asset classes. No single model was trusted to have the whole picture. The real power came from combining them, from letting them vote. If 1,000 different models, each looking at the market from a different angle, all point to the same conclusion, the probability of that conclusion being correct is significantly higher. This requires a profound sense of intellectual humility. It is the recognition that you will never have a perfect model of the market. Your understanding will always be incomplete. The goal is not to find the one perfect model, but to build a diverse ecosystem of many good but imperfect models. This is how you build a system that is robust and adaptive. It is how you avoid being the blind man who is certain he understands the elephant because he has felt its tail. The lesson is to never fall in love with your models. Be a ruthless critic of your own ideas. Constantly search for new data, new approaches, new ways of seeing the elephant. The market is a game of probabilities, and the more perspectives you can bring to bear, the more you will tilt the odds in your favor. This is similar to how modern weather forecasting works. A single weather model might predict a 30% chance of rain, but a supercomputer can run dozens of different models, each with slightly different starting conditions and assumptions. This ensemble of forecasts gives a much richer picture of the probabilities. If most of the models show rain, the confidence in that forecast is high. If the models diverge wildly, it signals a high degree of uncertainty. An investor who relies on a single model is like a meteorologist who only looks at one forecast. They are blind to the full range of possibilities. An investor who builds an ecosystem of models is like the meteorologist who uses the full power of ensemble forecasting. They are able to see the world in probabilities, not in certainties. And in the world of investing, that is a crucial advantage. The parable of the blind men and the elephant is a warning against intellectual arrogance. The moment you believe you have found the one true model of the market, you are lost. The market is not a static object waiting to be understood. It is a living, breathing organism that is constantly adapting and evolving. It is a reflection of the collective hopes, fears, and desires of billions of people. To think that you can capture all of that complexity in a single set of equations is the height of folly. This is why the culture we built at Renaissance was so important. We didn't hire people from Wall Street. We hired mathematicians, physicists, statisticians, and computer scientists. We hired people who were trained to be skeptical, to question assumptions, to look for flaws in their own reasoning. We created an environment where ideas were constantly being challenged and tested. We had a saying, "There are no sacred cows." No model was too successful to be questioned. No strategy was too profitable to be improved. This process of continuous improvement is essential for survival. The market is an adversarial game. The moment you find a profitable signal, you are creating an incentive for others to find it as well. Over time, all signals decay. The edges get smaller, the competition gets fiercer. The only way to stay ahead is to be in a constant state of innovation. You must be constantly searching for new data sources, new mathematical techniques, new ways of looking at the world. You must be willing to throw away a model that has made you millions of dollars the moment you find a better one. This is a difficult thing for most people to do. They get attached to their ideas, they take pride in their creations. But in the world of quantitative investing, attachment is a liability. You must be a ruthless pragmatist. The only question that matters is, does it work? And the only way to answer that question is through rigorous empirical testing. You must treat every idea as a hypothesis and every trade as an experiment. You must let the data be the ultimate arbiter of truth. That is how you build a system that can learn and adapt. That is how you avoid becoming the blind man who is forever clinging to the elephant's tail. People have always been fascinated by the idea of predicting the future. They go to fortune tellers, they read horoscopes, they listen to market gurus who claim to know where the Dow is headed next year. This is a deeply human desire, but it is also a deeply flawed one. The future is not a destination that can be seen from afar. It is a probability distribution, a vast landscape of potential outcomes. To claim to know with certainty what will happen is the height of arrogance. In my early days, I was a code breaker for the NSA. My job was to find patterns in what appeared to be random noise, but we never pretended to know what the next message would say. We were dealing with probabilities. We would identify a likely pattern, a statistical anomaly, and we would make a bet. Sometimes we were right, and sometimes we were wrong. The goal was not to be right every time. The goal was to be right more often than we were wrong, and to have a system that could withstand the inevitable losses. This is the same mindset that is required for successful investing. You are not a fortune teller. You are a risk manager. Your job is not to predict the future, but to build a portfolio that is robust enough to handle a wide range of possible futures. This means thinking in terms of probabilities, not predictions. It means asking not what will happen, but what is the range of things that could happen, and how do I position myself to survive and even thrive in each of those scenarios? This is why diversification is so important. It is the mathematical embodiment of humility. It is the recognition that you do not know which asset class will perform best next year, so you own a piece of all of them. This is also why position sizing is so critical. Even if you have a model that is right 60% of the time, you can still go broke if you bet too much on any single trade. A string of unlucky losses can wipe you out before your statistical edge has a chance to play out. The lesson is to abandon the fool's errand of prediction and embrace the discipline of probabilistic thinking. Build a system that is designed not to be right all the time, but to be profitable over the long run. Focus on managing risk, not on forecasting returns. That is the path to sustainable success. The desire to predict the future is a powerful one. It's what sells newsletters, what makes television pundits famous, and what leads countless investors to ruin. But the truth is, the future is unknowable. Not just difficult to know, but fundamentally and philosophically unknowable. The world is a chaotic system, full of feedback loops and nonlinear relationships. A small change in the initial conditions can lead to a dramatically different outcome. This is the so-called butterfly effect. The idea that a butterfly flapping its wings in Brazil can set off a tornado in Texas. In a system like that, long-term prediction is impossible. It is a fool's errand. So, what do? You abandon prediction and embrace probability. You stop asking what will happen and start asking what are the odds. This is a profound shift in mindset. It is the shift from a deterministic view of the world to a probabilistic one. It is the shift from the mindset of a fortune teller to the mindset of a casino. A casino does not know whether the next spin of the roulette wheel will be red or black. It does not try to predict the outcome. It simply knows that over thousands of spins, the odds are in its favor. The small green zero on the wheel gives the house a statistical edge, and over time, that small edge, compounded over millions of bets, generates a massive profit. The casino has replaced the impossible task of prediction with the manageable task of risk management. This is the essence of quantitative investing. We are not trying to predict whether the market will go up or down tomorrow. We are trying to identify small, persistent, statistical edges that will play out over thousands of trades. Our goal is to build a system that is like a casino, but with a much more sophisticated understanding of the odds. We use mathematics and computer science to find the green zeros in the market, the small, repeatable patterns that give us a slight edge. And then we build a system to exploit that edge over and over again with relentless discipline. This requires a completely different way of thinking about risk. A single trade is meaningless. It is just one spin of the wheel. You will have losing trades, you will have losing days, you will even have losing months. None of that matters. The only thing that matters is that your system has a positive statistical expectancy over the long run. You must have the discipline to stick with your system even when it is going through a period of losses. You must have the humility to know that you cannot predict the future and the wisdom to build a system that doesn't have to. There is a popular image of the brilliant scientist or mathematician working alone in his office, having a sudden flash of insight that changes the world. This is a romantic notion, but it is also a deeply misleading one. Great discoveries are rarely the product of a single mind. They are the product of a community, a culture, a conversation. They are the result of many smart people, all working on the same problem, sharing ideas, challenging each other, and building on each other's work. There are two models for how this kind of collaboration can happen. The first is the cathedral. In a cathedral, a single architect has a grand vision, and all the workers are organized to execute that vision. It is a top-down, hierarchical process. The second model is the bazaar. In a bazaar, there is no central plan. It is a chaotic, decentralized marketplace of ideas where anyone can contribute, and the best ideas rise to the top through a process of natural selection. At Renaissance, we tried to combine the best of both worlds. We had a single, unifying vision to use mathematics and data to understand and trade the financial markets. That was our cathedral. But within that cathedral, we created a bazaar. We hired the smartest people we could find from a wide range of different fields, and we gave them the freedom to pursue their own ideas. We encouraged open debate and collaboration. We created a culture where people were not afraid to challenge the consensus or to admit when they were wrong. This is a difficult balance to strike. You need enough top-down direction to ensure that everyone is pulling in the same direction, but you need enough bottom-up freedom to allow for creativity and innovation. The key is to create a culture of intellectual honesty, where the quality of an idea matters more than the seniority of the person who proposed it. You must build a system where the best ideas can win, regardless of where they come from. This is perhaps the most counterintuitive lesson of all. In a field that is so focused on data and models, it is easy to forget the importance of people. But the models do not build themselves. The data does not analyze itself. It is the people, the community, the culture that makes it all possible. The greatest challenge is not to find the perfect model. It is to build the perfect team, a team of brilliant, independent thinkers who are all united by a common purpose. That is the ultimate competitive advantage. If this way of thinking resonates with you, if you believe in the power of logic and reason over emotion and hype, then like this video and leave a comment. Write one sentence about how you will apply the principle of removing yourself from the equation to your own life or your own investment strategy. It is in the application of knowledge that its true value is realized. After 50 years of watching the markets and a lifetime of working with numbers, the most important lesson I have learned is that the greatest obstacle to success is yourself. It is your own emotional, biased, and narrative-driven mind. The solution is not to become a better predictor of the future, but to become a better architect of the present. Build a system grounded in mathematics, a system driven by data, a system that is immune to your own worst instincts, but do not build it alone. Build it with a team of brilliant, skeptical, and collaborative minds. Challenge everything, test everything, and have the humility to know that you will never have all the answers. That is how you move beyond the foolishness of crowds and the illusion of intuition. That is how you begin to see the world as it truly is. And that is the only way to build lasting success.